Hey everyone, it's Imran from Options Insight with your macro options spotlight. Okay, markets did get a lift yesterday from a lower PPI data print. Obviously, inflation being front of mind, and markets like it when it looks like inflation is coming down. But then that was so we did break back above 4,000, but then that was pushed back down by headlines late in the day of Russian missiles killing 2 people in Poland, stoking fears of geopolitical escalation, given that they're a NATO country. It turned out, though, that it probably wasn't or as sinister as it first looked like. Reassuring words from Biden saying that it didn't come from Russian territory, or that's what it looks like. Calm markets. And then the S&P headed back towards 4,000, which seems to be that gravitational pin going into this Friday's expiry. And for now, it seems to be behaving itself. Oil recovered, looking across the commodities, up about 2% on the day. But still not getting too excited, really, about the potential China reopening that the Chinese market certainly are going after. It seems like the oil market's more concerned with short-term demand, which doesn't seem great given what OPEC have been saying, and also the fact that COVID cases are still rising. So maybe it's a story for next year, the idea that on the China reopening, there's going to be a lot more demand for oil coming back to the market, but we might need to wait a few months to really see that materialize. Looking at volatilities, pretty mixed on the day in general across equities, although Asian indices have been falling in terms of vol. So you're seeing China and Nikkei in Japan down. So, FXI, even though it was up 2 sigma on the day, up 5%, we did still see vol soften, right? So vol markets there, but they are coming from a base vol of 43. So, that's where you're getting a bit of a easing back, whereas more Western indices are on a kind of 20 level, right? So they've got less downside now, given how much vols will come off. Commodity vols firming up in precious metals and oil. We're seeing that there, roughly 3/4 of a vol to a vol and a half. But nat gas still coming down 2 points, but it is still at 109, right? So nat gas vol is astronomical at 109. It is realizing 85, but it's not realizing above 100. So that may well still have a lot of room to correct lower, whether it happens into Thanksgiving or whether it happens into the end of the year. Who knows? It does seem like the real fears of European natural gas going to the moon into the winter have kind of abated. So that means that the US natural gas continues to kind of be a bit more range bound and not explode to the upside. Then I could definitely see these vols coming a bit softer. Carry wise, really not a lot coming back in terms of green. We are still green in Nifty and VIX and natural gas. Nifty's quite a funny one, given that the vol level, the implied vol level is at 13.5, which is by far and away the lowest vol level other than, say, FTSE, but it's realizing 11. So it just goes to show you that sometimes the lowest vol in absolute terms is often still the best thing to be short, whereas the stuff that trades at high levels is often the good stuff to own, right? So you look at NASDAQ at 28 vol has been realizing 45. So, sometimes expensive vol is good value. High vol is not expensive necessarily, and low vol is not cheap necessarily. So that's something to be aware of when you're trading volatility. In terms of skew, significant bounce in S&P skew. That's up 2 vols now on the week, back to the 13th percentile, and not really looking cheap anymore. So you look at S&P skew at 5. It hasn't been performing very well on a realized basis. In terms of where there might be some value still in skew, FTSE skew got whacked 80 bips. It's at 1.7 in absolute terms, which is pretty damn low, 0 percentile in terms of how far we look back at it. But the problem with that is I don't really see the FTSE falling out of bed. Even if we get bad news out of the UK fiscal statement, that's probably bad for cable, which softens the blow for FTSE. So that's something to be aware of. All right, moving on. I'm not going to go through FX and bonds. Instead, I'm going to jump over to the stuff that I've been looking at because we're looking at some interesting stuff today. So momentum shock. So this was something that's the last week, obviously an epic rally that we had in risk assets, but there's been a lot of pain under the hood. So Morgan Stanley put out some research showing that long-short momentum strategies had their worst 2-day drop in 20 years at the end of last week. So that's a pretty dramatic under the hood sort of movement going on, right? So you had the dispersion within markets resulting in CTA trend followers also experiencing huge drawdowns. and the year-to-date worst performing stocks were leading the rally, and the year-to-date best performers were lagging, basically, right? So you had that massive divergence between the winners and the losers of the year, and these guys are just giving large amounts of cash back. You've also had macro funds who have underperformed the recent rally. So you can see that here. So that basically saying that they're underweight and they don't have enough beta to the market when the market's up 6-7% in a matter of days, and they don't make any money. It just shows you that they're missing and not participating in that rally, which is why call volumes obviously have exploded and why Skew has been doing what it's doing. Okay, so this explains why we've seen so much demand for calls, because people just don't own enough the market. But the reality is, even though we've been seeing that call buying recently, it doesn't seem to have helped that much in terms of performance. And maybe that's because when you buy calls, if you don't sell them out quickly enough, they start decaying and the vol comes back down. Literally, if you wait a day too long, you can lose half the money that those calls have made you. And that may well be what's been going on, basically. So the pain trade might be higher, but if they've all bought a load of calls, then the real pain is a grind higher, maybe from here, where those calls don't end up performing, but your underweights are still a problem, basically, right? So that's something to maybe think about. Maybe the sharp part of the rally is kind of done for now. Okay, now looking at Skew, cheap equity Skew. So we've been flagging, obviously, that Skew's been coming down over the last month or so. Obviously, it's had a bounce in the US. So we've seen a general trend lower in Skew. Now the green, the bright green has bounced. That's the S&P. So that's popped back up here in the last few days. But European Skew is still relatively cheaper. So that's Eurostoxx, DAX, FTSE, etc. As is Asia. So you've got India and Nifty down here with a Skew sub 2 vols, which is quite cheap. Now, given the sharp move that we had up in the market, obviously we've gone to the top end of all the ranges or the Bollinger Bands. That's why we're seeing this clustering of bearish risk reversal in our strategy compass. So generally, it's a good time to be putting on hedges if you haven't already done so. And just if you want to tactically be short the market, it's also a good time to be looking at bearish risk reversals, given that Skew has flattened quite significantly. So you're not paying a crazy implied vol for the puts that you're buying relative to the calls that you're selling. Now, if you wanted to do the ultimate risk reversal based on where we're seeing volatilities and Skews, what you might look at is something like selling the FXI calls, because the FXI vol is elevated and the Skew is quite flat. So that means call vols are quite expensive in FXI. And then you would buy the puts on Nifty, because Nifty has got the absolute lowest vol out of all the indices, and it's got the flat Skew as well, which means the puts are trading at like a really, really cheap vol. Now, that's a bit of a funky one. It's probably a bit more exotic for most people, including myself, to be honest, because your issue is you need market access to the Nifty. So you can have brokerage accounts and be a foreign investor into Indian markets, but it is a bit of hoops to jump through, so not everyone's going to manage it. But just to know, some of the opportunities out there, if you thought there was a big macro crash coming and it's going to impact all markets, including Nifty, then you might want to set up a brokerage account that gives you access to that market, because you're getting downside protection at incredibly cheap levels relative to any other markets out there, right? So that's just something to maybe think about. Now, if we then compare equity Skew to bond Skew, right? So obviously we said that equity Skew has been trending lower, but what about bonds? So Skew in bonds tends to be a bit more variable depending on the macro environment, the inflation outlook, the policy risks, things like that. So sometimes bonds can have their tail risk to the upside, sometimes to the downside. Now, in a higher inflation regime like the one that we've had, stocks and bonds tend to be well correlated. And because we know the Skew in stocks is always to the downside, or tends to be to the downside, then that also means that the Skew in bonds has been the same way round. So we've seen, as all the spikes in the move index, which is like, let's say, our rates volatility gauge, and I've inverted that on this graph here. So all these spikes in the move index have tended to happen when bonds have sold off this year. So it's saying when bonds have moved to the downside aggressively, that's when you've seen big spikes in interest rate volatility. Okay, so the realized Skew that you've seen in bonds has been pretty good, right? So you had the TLT, has been working its way lower over the course of the year. And you saw this decent move up in volatility. So you had implieds go as high as 30 vol in TLT. So a move down in spot and a nice big move up in volatility. So that's what we call realized Skew. On the S&P, on the other hand, you look at the same chart. And yes, we've had a move down from 4,200 down to 3,500. But look how orderly that's been. It's not happened at such a steep gradient. And that's really evidence that the skew in equities has been pretty lame and has underperformed and hasn't really done what you thought it was going to do for you, basically. So now the question is, so based on the fact that we know that bond skew has worked well to the downside, what about the current setup? Okay, so lately bond skew has moved all the way back to neutral. So puts are not really trading at a premium anymore. Bond skew's trading quite flat. So puts and calls are quite symmetric. And you can see that from this green line here being quite flat around there, right? There's no premium between calls and puts. And you know, it's because we've got this peak inflation narrative building. Bond volatility is also collapsed as bond prices have recovered. And we personally we think that inflation doesn't roll over as fast as markets want it to. And we do think that the tail risk in bonds is still lower. Okay, so we think that if bonds do reprice down, that because inflation's still here and it's not collapsing as fast as you want, then you can get quite a quick repricing in bonds and bond volatility comes back. So we think bond skew has got the potential to work quite well, right? And even if bonds continue rallying, why are they rallying? Because inflation is rolling over. But looking at the macro indicators, it doesn't look like a recession is going to hit for another couple of quarters. So you might have this window of Goldilocks scenario where inflation's coming down and growth's still okay. And bonds don't need to go to the races in that environment, basically, right? Yes, obviously, if we think there's a recession coming and coming quick, bonds might explode higher. But we think if inflation continues to come down and we don't see a recession immediately, then we don't think bonds are going to explode to the upside, right? This recent rebound in bonds is more a reflexive bounce from oversold conditions. So we don't really think that a rally in bonds from here needs to be so aggressive in the next couple of months at least, right? So that's the scenario that I'm looking at. And you can see TLT here, the trend in TLT, if we go back to the start of the year, the upper limit of that trend channel is kind of around 105 on TLT, which is about 5% higher than where we are right now. Okay, so what's the trade on the back of that? That's something I cover in my boot camps, and we are running a boot camp with Spot Gamma in December. So, you know, come and check us out or inquire about that and find out more. But that's it for today. And I'll catch you guys all tomorrow. Thanks.